welcome back to The Explainer. Okay, so you have done all the hard work. You've got your personal finances dialed in, and you are ready for the next, really exciting step. It's time to stop just saving your money and start making that money work for you. It's time to build some real wealth. But first, let's do a quick check-in. That high-interest debt, is it handled? If you've already tackled that, high five. You've cleared a massive hurdle. And what about your emergency fund? You know, that solid financial cushion for whatever curveballs life decides to throw your way. If that's in place, you are standing on solid ground. Which brings us to the big question. With that solid foundation secure, what is the smartest way to start building real, long-term wealth? Well, that is exactly what we are going to break down right here, right now. I want you to think of this as building your very first investing toolkit. You don't need some huge, complicated toolbox with 100 shiny gadgets. Nope, you just need a couple of really powerful, super reliable tools to get the job done right. And for a new investor, the two most essential tools in that starter kit are index funds and exchange-traded funds, or as you'll hear them called, ETFs. They are both absolutely fantastic options, and we're about to see why. All right, let's grab our first tool from the kit, the index fund. I like to think of this as the reliable, all-in-one workhorse of your toolkit. It's strong, it's simple, and it is incredibly effective.
So what is it really? Well, an index fund is a type of mutual fund, but its job is super simple. It just copies or tracks a specific market index. You've probably heard of the S&P 500, right? Well, an S&P 500 index fund doesn't try to outsmart the market. It literally is the market. It holds a tiny piece of all 500 of those huge US companies. So you buy one share and boom, you're instantly invested in the biggest players in the game.
So let's peek under the hood. First, they're passively managed. That just means there isn't some high-paid manager trying to be a stock-picking genius. And that's great news for you because it leads right to the next point. Super low annual fees. You get to keep more of your own money. You also get what's called instant diversification. The only kind of quirky thing to know, they only trade once a day, right when the market closes. And let's really let that sink in. Instant diversification. Instead of you stressing out trying to pick the next big winning company, you just buy the whole basket all at once. It's like a built-in safety net. It spreads out your risk and makes investing so much simpler. For anyone just starting out, that is an absolute game changer. Okay, let's grab tool number 2, the Exchange Traded Fund, or ETF. Now, if the index fund is our trusty workhorse, think of the ETF as a more flexible, specialized instrument. It's built with the same high-quality parts, but it operates a little differently. Okay, so here is the number one thing you need to know. An ETF also tracks an index, just like our index fund. But, and this is the big but, it trades like a stock. That means you can buy it, you can sell it anytime the market is open. The price is changing from moment to moment, just like if you were trading shares of Apple or Amazon. And that one difference, trading like a stock, gives you so much flexibility. Now, just like index funds, they have those beautifully low annual fees, but they do have a couple of extra perks. You get high transparency, so you can see exactly what the fund owns every single day. And depending on the situation, the way they're structured can sometimes be a little more tax efficient for you. So, okay, we've got two amazing tools on the workbench, an index fund and an ETF. Now, this isn't a competition. It's not about which one is better in some absolute sense. It's all about which one is better for you and your personal investing style. So let's put them side by side. The big kahuna, the main difference is trading. Index funds, once a day at the closing price. ETFs, all day long with prices that move with the market. And this all comes from their structure. One's a mutual fund, the other acts like a stock. But here's what I want you to notice. Look at what's the same. They are both passively managed. And that is the secret sauce. That's why they are both such great low-cost ways to invest. So how do you choose? Well, let's make this really simple. Are you a set-it-and-forget-it kind of investor? Do you love the idea of just putting your money in on a regular schedule, maybe automatically, and not thinking about it? The index fund is your soulmate. It's perfect for that. Or, are you someone who wants more control? You want the flexibility to jump in and out, to buy or sell whenever you want during the day, maybe to react to market news? Then the ETF is built just for you. All right, so as we start to land this plane, what is the single most important thing to take away from all this? It's really, really simple. Just get started. Don't let the choice between these two fantastic options stop you from taking that first step. Look, at the end of the day, especially when you're just starting out, the differences we've talked about are pretty minor. The key thing, the most important thing to remember, is that both of these are unbelievably powerful tools. Choosing an index fund or an ETF, it's like choosing between two incredible ways to build a diversified, low-cost portfolio. You honestly can't make a bad choice here.
So, you've seen the toolkit. You now understand the two most essential tools for building wealth. The only question left is, what kind of builder will you be? Are you going to be the set-it-and-forget-it planner or the flexible, hands-on trader? The choice is all yours, and the best time to start building is right now.